Good morning, everyone. Imagine you were a manufacturer in Ohio, but you have just received $1 million order from a buyer halfway across the world. But you don't know their face, you don't know their history, or you don't definitely don't know the legal system. But you are about to put a fortune's worth of a product on a ship and simply hope for the best. But in a global commerce, we call the gap of trust. For a century, we have just letter of credit as the we have just used that LC as a bridge of the gap. But today I am going to show you this: the bridge isn't held together by the legal contracts we are taught to rely on. It's held together by something much more interesting. Okay, coming on the next slide, and we'll start our thing. The standard model, the previous thing that has been on work for the years, and like in this, let's just start with the textbook definition, what we call the standard model. The bank sits in the middle like a neutral referee, and the entire system is built on the independent principle. The bank deals on only on documents, never the actual goods. If the seller provides the right paperwork, the bank is legally obligated to pay. It is designed to be a cold, mechanical, and perfect exchange of paper of money. But here comes the but, the problems. Like, why do we bother with this? No, it's just a thing that has been working for years. But what is the problem in this? Why do we bother? Because the trade is inherently dangerous. The letter of credit is the ultimate safety net. Buyer risk, the fear that they'll go broke or change their mind, and replaces it with bank risk. So a global bank's promise is as good as gold. Once the credit is issued, the seller can sleep at night, knowing that the buyer cannot stop the payment if the documents are correct. But in this case, let's give you a reality check. In this, the big bang of the data, like if the system relies on perfect documents, you would expect the accuracy to be the norm. However, the Ronald J Mann's research found that the 73% of the documents presentation failed in nearly three out of every four transactions. So we can see that the seller makes a mistake, and legally speaking, the bank's absolute promise is to pay the actual void in 73% of the cases. So we can say that the safety net has a massive hole in it. Just we just heard about the failures. Just let's just go into and delve into the anatomy of the failure, because just have a check on the reasoning. So what are the errors? It's just not the typos. While 59% are technical, nearly 30% are substantive issues. Late shipments, expired credits, or missing certifications. We can fit this into the department. Under the strict rules of the trade finance, there are breaches. Contract by the book, the seller shouldn't be getting paid at all. So let's just come to the point. There's a paradox of the waiver. How does it work? Yet, here is the real mystery. If the 73% of the presentations are legally bad, the system should be collapsing, right? There's no doubt in it. But the actual payment rate is staggering in 99.7%, is huge. So how this is happening? Even though the documents are wrong, the buyers choose to waive the errors and pay anyway, often within just 24 hours. This raises a massive question. If the buyer is going to pay regardless, so how the legal guarantee is technically broken, and why the companies are paying 2,500 in fees per transaction? Why? Who gets answer? I don't know. But in saying that, let's get into the next slide. It's a irrational habit. No, let's get into the some statistical data. So we can say that the value for money, like this isn't just an old habit. The world's largest retailers use a letter of credit systematically. They could use open account for free, but documentary collection for a few $100. Uh, Little bit there should be a reason, right? Instead, they chose the most expensive option. They aren't paying 10 times the price by accident. They are buying a value that doesn't appear in the legal text. So this is the reason for. Now let's see a like the payment assurance, the limits of payment assurance in respect of the import and export. Like the data shows a fascinating global split. When the US sellers export, they work hard to fix the errors, showing that they really value the bank guarantee. But for goods flowing in the US, the paperwork is sloppy and banks barely check it. But the payment guarantee theory, they explains some behavior, but it can't explain why the system, how the system thrives despite so much sloppiness on the import side. Yeah, in the next slide we can see that the thing we are talking about, the new theory, the verification institution. Like the real secret is the letter of credit is not just a payment tool, it is a verification institution. Here, um, in a world of strangers, it solves the information asymmetry. Like it's not just about the money, it's all about the verification, verifying the truth that will you pay, that the seller is going to have the payment, or it is going to be on time, or there will be late, and there will there be any issues. And this is just the verifying the truth, nothing else. So we cannot just tell this as a tool, it's a system that has holding the whole trading system. So in the next, just we can say that the uh, following the verification process, like it's what's an intermediary. Think of the first layer as a renting reputation. A seller on in Ohio can't easily check the character of a buyer in a developing market, but the local bank knows them. Yeah, because they are in the same country or same region. By issuing the letter of credit, the bank signals to the world, we have vetted this buyer. They are reliable. The bank becomes the bridge between an unknown buyer and an unnervous seller. Because the seller should be nervous because they don't know, and he just puts the goods on the ship and he doesn't know there will be payment or not. So the nervousness in the seller is normal. And the here comes the bank, the as a gatekeeper. The gatekeeper thing is just perfectly said. The banks act as the guarantees guardians, and he just gives a guarantee of the commercial probity. They don't just look at cash, they look at character. In the study, the bankers admitted that they admitted that they will actually fire customers who try to use minor paperwork errors as an excuse to back out the deal. The bank uses its massive leverage to ensure everyone plays fair, ev- uh, even when the law might give them an excuse not to. So there's a fair game all over the process. And coming to the what do you say that the authentication of the transaction. Yeah, there is also the layer of transaction authenticity in countries with strict currency laws. The governments are terrified money being smuggled out under the guise of fake trade. They require a letter of credit because the trust of the bank's expertise is spot a fraud. The bank verifies the trade is so real that the government doesn't have to. Yeah, this is the main thing that should be done. Let's come to a case study, the packing credit. Like a perfect example of this is in Hong Kong. A small factory needs a loan to buy materials to build your order. So they have a purchase order, but a bank won't lend on that because a PO is easy to forge. However, a letter of credit from a major global bank is nearly impossible to fake. Yeah, it's so much impossible. But everywhere there's a loophole, but it is nearly impossible. That document becomes the source of truth, and and that unlocks the financing the factory needs to start working. So this is how it works. And in summary, we can say that to wrap up, we have two different views of the system. The standard view says the letter of credit are a legal contract that fails 73% of the time. The empirical reality shows that they are a choose to pay. Like, this is a system with a 99.7% success rate. The true value isn't the legal guarantee, it's the information. It's a signal that the buyer is trustworthy and the transaction is legitimate. So in the last thing, just we can just say this is a breach of trust from with the buyer and seller. um, when we are separated by oceans, laws, cultures, and we're so much diversified in our own sectors, but we don't need more lawyers, we need more verifiers. The bank here, the bank fills up the gap. It allows us to trade with confidence, not because the paperwork is perfect, but because the reputation behind it. So it just works as a what do we say, that the bridge that is hanging on the in between the oceans, the cultures, and the diversity that we have, but it's connecting the buyer and seller far away from each other. And this is Tausif Swat. This was from me. Thank you for listening. Assalamu alaikum.